Hi everyone, my name is Rhythm. Today, Group 8 will be presenting our financial analysis of Lion Company and Tiger Company. Let me first introduce our team members Sarah, Longstar, Shenyang, Andy, and myself. So today our presentation is going to divide into four main parts. First, Sarah will cover the vertical analysis, including an overview of the income statement and the balance sheet for both companies. And next, alongside and I will walk you through the ratio calculations and comparisons between the lion and the tiger. And after that, Shenyang will evaluate the financial health of the two companies, then providing you a deeper analysis based on the ratio data. Finally, Eddie will present our investment recommendations for each company individually. So we hope you find our analysis quite insightful. And so let's get started.
Thanks, Rhythm. Hi, everyone. I'm Sarah. In this part, I'll introduce vertical analysis, a method that expresses each item in the financial statement as a percentage of base figure. For income statement, the base is sales, and for the balance sheet, is total assets. This approach helps compare companies of different size by showing the relative weight of each item. It's especially useful for identifying differences in cost structure, profitability, and financial position between Tiger and Line. Okay, let's take a look at the income statement. Vertical analysis shows that Line has a higher gross margin at 28%, showing that better pricing power or stronger cost control. Although both companies have similar operating expenses as a percentage of sales, Line handles them more effectively thanks to its stronger margin. We also noticed that Line has a higher interest expense, which indicates it relies more on debt. This can increase returns, but also adds financial risks. So, in the end, Line's net profit margin is 9%, slightly higher than Tiger's 8%, showing stronger overall profitability. These differences suggest that Line is following a premium growth driven strategy, while Tiger may need to boost its margin by scaling up or cutting costs. Now let's look at the balance sheet. Tiger holds more current assets like cash and receivables, offering short-term flexibility. Line has more fixed assets, which helps supporting long-term growth, but it also means higher ongoing costs. Tiger's high level of receivables may indicate more generous credit terms, while Line's higher cash balance gives it a stronger short-term liquidity. Line also has more retained earnings, showing stronger profit and the ability to fund its own growth. In short, Tiger is more flexible in the short term, while Line's capital-heavy model offers greater long-term stability but also demands careful financial management. To conclude, our vertical analysis reviews three key strategic insights. First, profitability. Line's higher margins shows stronger cost control and pricing power, while Tiger manages to improve efficiency or differentiate its products. Second, assets flexibility. Tiger's more liquid structure supports short-term adaptability, while Lion's fixed assets enable long-term growth but adds financial pressure. Finally, financial risk. Lion's higher leverage increase both returns and risk, requiring careful management. Tiger's lower debts offer stability but may limit growth. In short, both firms has distinct strengths that support different strategic directions. Now I'll hand over to my teammate Longstar to walk you through the ratio calculations and comparison section.
Thanks, Sarah. Let's talk about liquidity. Looking at working capital, both Tiger and Lion are in a healthy position. Tiger has around 114,000, while Lion has about 111,000. Since both are positive, they can cover short-term debts. Tiger's slightly higher amount means it could handle daily operations a bit more easily. Let's look at the graph. Both Tiger and Lion have strong current ratios, about 2, which means they can pay off short-term debts easily. Tiger's data is slightly higher, which means it is a little more safety. As for the quick ratio, both companies are equal at 1.2. This means they can still pay short-term debts using cash and receivables, even without selling inventory. All in all, both companies have good short-term financial health. For the solvency analysis, as can be seen from our graph, Lion has a lower debt ratio. It uses less debt and has a more stable structure, and its debt-to-equity ratio is also lower, showing it's more careful with borrowing. On the other hand, Tiger relies more on debt, which can increase return but also increase risk. For interest coverage, both companies are strong. For the efficiency analysis, Lion's receivables turnover is about 8.74, much higher than Tiger's 4.89, which means Lion get cash much faster. For inventory turnover, Lion has nearly 6, while Tiger is just over 3. It shows Lion manages stock more efficiently, and Lion's total asset turnover is around 1.48 compared to Tiger's 1.03. That means Lion used the asset better to generate sales. For the days sales in receivable and inventory, Lion's collects its receivable much faster, taking about 42 days compared to Tiger's 75 days. This quicker collection helps Lions improve cash flow and reduce bad debt risk. When it comes to inventory, Tigers holds stocks for around 109 days, almost twice as long as Lion's 62 days, which may indicate slower sales or overstocking.
So now let's looking at the two key profitability indicators, which are gross profit margin and the net profit margin after tax. As you can see on the chart, Tiger has a gross profit margin of 26%, while Lion Edge is slightly ahead at 28%. This tells us that Lion is likely managing its production costs better or has stronger pricing power, which means it makes a bit more profit for every dollar of sales. Next, about net profit margin after tax, as Tiger comes in at 9%, and Lion again takes the lead at 10%. So this suggests that Lion is more effective at controlling its overall expenses, like operating costs, interest, or taxes. So overall, I think Lion is showing stronger cost efficiency and better financial management. And then now let's move on to the return on total assets and the return on equity. This is where we start to see a bigger gap as Tiger has a high ROA of 10%, but Lion really stands out with higher 16%. That means Lion is using its assets more effectively to generate pre-tax profits, which possibly due to better asset turnover or smart investment choices. And when we look at the return on equity, Tiger reports 18%, but Lion once again pulls ahead with 24%. This means Lion is generating more profit from every dollar of shareholders' equity. So it's likely by using leverage wisely and maximizing the value for its investors. In this pie chart, you will see that Tiger's PE ratio is 59%, quite a bit higher than Lion's 41%. This suggests that investors are more optimistic about Tiger's future growth or view as it is more stable and less risky. So on the flip side, as Lion's lower PE ratio might mean the market expects lower growth, sees higher risk, or they possibly thinks the stock is undervalued. So while Tiger is currently enjoying more investor confidence, Lion might be seen as a potential value opportunity. And now, lastly, let's talk about the dividend yield. And you looking at the pie charts. both companies offer the same dividend yield. That means the investors in either company can expect similar cash returns from dividends, which relative to the stock price. So this shows that both Lion and Tiger are equally committed to returning value to our shareholders while still keeping enough funds to invest back into the business in the future.
Hi, I'm Sen Yang. I'm going to talk about the financial health overview. The following part of the presentation provides an overview of the financial health of Tiger and Lion Company by looking at the liquidity, solvency, efficiency, profitability, and market perspective from the calculated results. The first ratio discussed is liquidity ratios, where we looked at quick and current ratios. Tiger's current ratio is a bit higher than Lion's, but both companies have current ratios larger than 2. A general benchmark, we can conclude that Tiger and Lion both have the robust short-term financial stability. Since both companies have the same quick ratios, Tiger has stronger abilities to manage short-term debt. The second is solvency ratios. Lion has a higher debt ratio, so Lion relies more on borrowing to buy assets. For debt to equity ratio, Lion's result of 0.7 means that for every dollar of equity, it holds around 0.72 in debt. Lion's debt to equity ratio is significantly lower than Tiger's, so Lion has a stronger equity position. Also, both business can generate enough earning to cover interest payments from debts. Overall, Lion has a stronger long-term financial stability when economic conditions change. The third efficiency ratios and results show how Lion outperforms Tiger in all ratios. For example, the difference of 4 units in AR indicates that Lion collects receivable 4 times higher, so it shows Lion's effectiveness in collecting receivables. Also, Lion's higher asset turnover ratio means better profit generating abilities. Overall, the ratio show Lion's ability to convert resources into profit rapidly and effectively. However, Tiger should reflect on its current efficiency policies. Profitability ratios are important to reflect the ability to obtain earnings from its revenue, assets, and equity. Line outperforms Tiger in growth and net profit margin. Line also has a high ROA of 16.4%. Therefore, investors can think about Tiger's effectiveness in using assets available, where Line has more effective cost and assets management that leads to healthier profitability. Finally, the market perspective ratio presents an interesting point, since Tiger has notably higher P/E ratio of approximately 19.69. This means the investors are willing to pay about 19.69 per dollar of Tiger's earnings. The difference suggests how investors expect stronger future growth or profitability for Tiger's business. For dividend yield, both companies present a result of 6%, so investors would expect the same dividend payment related to stock price.
The financial data tells us more than just who earned more profit. It shows how well each company is managed and how strong their position is for future growth. Lion's higher net profit margin of 11.35% compared to Tiger's 7.48% suggests it controls cost more more effectively and earns more from every dollar of sales. Its return on equity of 23.7% also tells us that shareholders are getting more value from their investment. And operationally, Lion collects receivables faster, within 42 days compared to Tiger's 75, and it turns over inventory more efficiently. These things improve cash flow and reduce the risk of short-term funding problems. Lion's debt-to-equity ratio is also lower at 0.7, meaning it relies less on borrowed money, which makes it less sensitive to interest rate changes. At the same time, it holds almost double the retained earnings, showing it has more internal resources to fund future growth. Even the lower P/E ratio of 13.7, suggests the market hasn't fully priced in its performance, possibly making it a good value pick. All of these signals point in the same direction. That Lion is stronger financially, more efficient operationally, and better positioned for long-term success.